to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. According to Alpine Macro, they observe that stocks and bonds have diverged, with stocks way up over the past 12 months and bond prices way down over the past 12 months. That divergence is highly unusual, particularly when inflation is still elevated and monetary policy is still restrictive. So the key question is, how long can this divergence last and how far can it go? Well, it all depends on the soft landing scenario to the economy, whether we will in fact have a soft landing, or if possibly the US economy goes into a recession. They caution that there are long and variable lags between monetary policy and economic activity. Those lags suggest that the cumulative impact of monetary tightening, which began 18 months ago, will intensify in the early part of 2024. How stocks react depends on the depth and the severity of the growth downturn. And of course, it's likely that the growth downturn will be mild and short-lived. The reaction to the share market also depends on the Fed's reaction. The growth downturn is bearish for equities, but if the Fed pivots quickly to ease policy, stocks should react positively based on historical experience. The problem at the moment is that the soft landing scenario appears to be the consensus forecast. Stocks, bonds, and money markets have mostly priced in a perfect economic landing. And this is borne out by the Bank of America's Global Fund Manager Survey. It comes out every month. In September, 74% of fund managers expect either a soft landing or no economic landing at all. And that is a slightly worrying consensus. I like this sentence from Alpine Macro. They say the impact of earlier monetary tightening can only increase with time. So that is a caution. Of course, now we turn not to this year, but to next year, and that's what's important. Capital economics are bullish. They still expect the economy to enter a rough patch in the fourth quarter. We do not expect the S&P 500 to make more headway between now and the end of 2023, even if core inflation continues to fall. We think the S&P 500 will drop back slightly. However, we project the US stock market will make hay next year as a recovering economy and enthusiasm for AI drive up expected earnings per share, while looser Fed policy and growing appetite for risk boost index valuations. Investors are underestimating the extent to which monetary tightening will slow the economy in the coming quarters. We can buy into that. We've revised up our end 2023 projection for the S&P 500 to 4,200 from a previous level of 4,000, but that still means a decline of 7 or 8% between now and the end of the year. But let's look forward to 2024, 2025 projections. End of 2024, they're projecting 5,500 and 6,500 by the end of the following year. And of course, investment companies that form the OAM global portfolios, if there's a sniff or a hint that there's going to be a strong market in 2024 and 2025, those NAV discounts will narrow ahead of time. because the investment company universe and market is mostly made up not by retail investors, but by professional investors, and they tend to be ahead of the curve. I'm going to turn now lastly to the People's Bank of China, the outlook for China's markets. There could be a big opportunity for us there. World central bank liquidity is all important. Cross-border capital has observed strong injections into liquidity by the People's Bank of China. The index there is at 80.7 points on a range of 0 to 100. So that is bullish. There's obviously a lag time, but it's definitely very bullish for China's markets. Monetary easing suggests there should be some pickup in economic activity ahead. This is in contrast to the extremely downbeat media coverage on China currently. The correlation between the PBOC liquidity injections and the subsequent momentum of the Chinese economy suggests that Chinese economic activity looks set to accelerate over the next few months. Capital economics, they expect Chinese equities to fare better than those even than the US in the near term. Stronger than expected August activity data, the flow of economic news might be a bit different over the next few months. While the property sector remains an area of concern, we suspect a modest cyclical recovery in growth in China may now be underway. And then Alpine Macro have some really amazing observations and analysis on China in terms of the longer term structural opportunity. So this is it. Previous gloomy predictions on China have all failed to materialize. And history suggests that one should never underestimate the Chinese authorities' ability to make abrupt policy and ideology changes. It's interesting to note that Chinese stocks have stopped underperforming in recent weeks amid the intensifying doom and gloom. We believe China's current growth difficulties are a man-made disaster due to repeated policy mistakes rather than an inevitable slump due to deeply embedded imbalances. Business activity should be able to rebound if policy mistakes are corrected. Ultimately, Beijing cares about economic performance and will be forced to take stronger actions if downward growth pressures continue to intensify. The Communist Party has engineered massive directional changes in its ideologies throughout history. Beijing is aware of the damage to the private sector and has been trying to revive business confidence. It is premature to conclude that the current ideological left turn is permanent. China's government debt buildup is primarily being used to finance capital spending, while most other countries are borrowed to finance expenditures and social transfers. Focusing solely on debt ignores the hefty assets on the Chinese government's balance sheet. Netting out debt, Chinese government net financial assets, mainly fiscal deposits and equity holdings in state-owned enterprises and banks, are by far the largest among major economies, according to IMF estimates. Beijing may need an ideological breakthrough to regain the trust of private business owners and households. Similar, and it's happened before, similar to Deng Xiaoping's southern tour in 1992, and Jiang Zemin's 3 represents in the year 2000. Both ideological switchbacks happened when the Chinese economy was facing enormous growth difficulties, and both unleashed dramatic and enduring growth impetus. Okay, so that's it from my side. Gielie, all good on your side?
Hi, Nick. All good, thank you. Locally, FirstRand brought out results up to June. The normalized earnings per share, HEPS per share, was up 12%, and the dividend was also up 12%. So the dividend yield at the moment is 5.5%, and that is nothing to sneeze at. The share price is 70 Rand now. The price earnings is 10.8, and the net asset value of FirstRand is 32 Rand. That is versus a share price of 70 Rand. So there's a premium of about 100, of just more than 100%. FirstRand pays a lot of attention to the return on equity. They want to keep it above 20%, and it came out at 21%, which is good. The balance sheet is strong. Total profits were 36 billion Rand. It is interesting where that profits comes from. 60% of the profits comes from FNB, the bank, and 25% of it comes from Rand Merchant Bank. So most of the profits are from the 2 banks. The rest are from Westbank and then the UK operations. Something about CEOs, they are much in the news now. David Herwich, he's age 51, the CEO of Transaction Capital. He has resigned unexpectedly, and after that, Transaction Capital shares took a knock. It dropped 40% over the last week. And Bob van Dijk, he's also 51. He's the CEO of both Prosus and Naspers. He also resigned unexpectedly. They've appointed an interim CEO. He's Urban 2. He reported to Bob van Dijk, and I've read something about him. He's very capable. I won't be surprised if they appoint him as a permanent CEO. The main point on the agenda is South Africa's participation in AGOA. It is the African Growth and Opportunity Act. Our participation will end in 2025, but they want to extend it for another 10 years. And then it's net selling of shares on the stock market, on the JSE. It is now over 112 billion to date, the net selling of shares, and it's perhaps, this big selling of shares is perhaps one of the reasons why the JSE isn't doing so well at the moment. And then statistics, the gold production figures for July came out. Gold production was up 12.9% in July, year on year. The previous month it was up 28%, so it is down from 28% to 12%. It's a drop of nearly 16%. And the reason for that, the main reason, is the ongoing load shedding. And mining production is the same story. It is down 3.6% year on year in July. In June, it was actually up 1.3%. So there's also a month-on-month drop of nearly 5%. Just to clear up, the mining production includes gold that we've just had, but it also includes diamonds, nickel, platinum, coal, iron ore, copper, and other metals. And the month-on-month drop is also due to ongoing load shedding. Over the past year, there was only 2 months, that was in April and June this year, that mining was positive. The production figures was positive. Mining is a big exporting industry. It creates a lot of jobs and it creates foreign valuta for South Africa. And this won't be good for the income tax collections from the mines.